Hey everyone, I'm Owen from Rask Finance, and in this very quick video I'm going to tell you the difference between revenue and profit and how you get the two together in one statement. Okay, so first of all we have an income statement. Now an income statement is one of the 4 statements that you'll find in an annual report or when a company releases its results. So this is a very short version. Normally they'll be a bit longer than this and they'll include a few more line items as you go down the page, but I've made this very simple for obvious reasons. So firstly, what is revenue? Well, revenue is the thing that's at the top of the income statement, and it's what you get from selling something. So you might sell a service. For example, you might be a professional and you sell your labour or your hours. You might be a manufacturing company and you sell widgets or you sell particular items. It could be anything that you get from the customer, and it's when you receive it, that's when you normally record it. But it can be a little bit, there can be things hidden in the fine print. So the best way to understand how a company reports its revenue is to go to something called the notes to the financial statements. And you'll find that in the annual report of the company that you're looking at, and it's generally after the 4 major financial statements, which are the income statement, the profit, the balance sheet, the cash flow statement, and the statement of changes in equity. So if you find those 4 statements and then you go beyond them, you'll find the notes. And the notes tell you how they record each of the different items on the income statement. So as you'll see here, revenue is actually the top line item. And so we call it the top line. So if an analyst or someone that thinks they're really smart with finance and investing and they love jargon, they can say the company grew its top line by 10% this year, meaning they grew revenue by 10%. Now, if you're analysing a company, it's important to know how they get to revenue. So what do they sell and how many times do they sell it? And that will give you the revenue. So I'm going to cut this a bit shorter and I'm just going to explain how we link from revenue to profit and the difference. So revenue is at the top of the income statement. Anywhere you see red here is something being taken away. So let's go. Revenue, that's what the company sells. Then we've got the cost of goods. So this is just like costs that are just required by the business. So you have revenue minus the costs, and that will give you something called gross profit. Now this can also be called gross margin. So don't be confused between that and actual profit. I'm about to explain the difference. Then you take away the expenses. So this might be marketing, sales and admin, all the expenses that you can identify as part of a business, you need to take these away. So we've already taken away the costs, now we need to take away the expenses. That gives us something called EBIT or operating earnings, and we've explained that in another video. Once we get to this item, we need to then exclude interest, so interest that the company might earn from its cash in the bank or pay to lenders if it's got debt. And then we need to exclude taxes, because obviously taxes need to be paid by the company, so we exclude them. And then after we've taken all these red things away from revenue, we have profit. Now, you would know profit as, I bought this pen for $1 and I sold it for $1.50, therefore I made a profit. Now, as you can see, that's a little bit different to what a company reports. Obviously, there's all these different things that need to be incurred in order to make a profit. Now, we call this the bottom line because it's the bottom line. On an income statement, that's the top line, this is the bottom line. So when a company says it grew its bottom line by 10%, that means it grew profit by 10%. Now here's the confusing part, and I just want to make this distinction really, really obvious because many people, particularly those who are new to finance and investing, don't understand it. Profit is exactly the same thing as earnings. When they say net earnings, it means net profit. And when we say NPAT or NPAT, it means net profit after tax. So NPAT, they're the same thing. Now, some people will be confused and they will say earnings as in EBIT, so this line item right here. And why they say that? It's simple. This EBIT represents the operations of the business. Earnings before interest and tax represents the operating earnings. So some people, some analysts in particular, will just say the earnings of the business, and they'll exclude these 2 things. And I've explained why they do that in another video. But basically, you can see revenue's up here, profit's down here. Gross profit's probably somewhere in between, maybe towards the top, but you can see there's a lot of water that needs to go under the bridge to get from revenue to profit. So a company needs to control its costs, it needs to control its expenses, needs to hopefully not pay too much in interest if it has a loan with the bank, and it hopefully doesn't have to pay too much taxes. That's why if taxes are cut by the government, it's a good thing for a company because it means it pays less down here. It means more profit for shareholders. So revenue at the top line, profit at the bottom line. And don't be confused, earnings is basically the same thing as profit. I'm Owen Raskovich from raskfinance.com. If you have any more questions, be sure to head to the Rask Finance website and we'll be happy to answer them for you there.